Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, February 24th, and I'm recording this from my office in Purchase, New York. In recent months, shifting market dynamics have kept U.S. equities churning in a tight range. While some investors may be surprised by the fading of the Magnificent Seven, we have actually been more taken with the resurgence of European equities. The MSCI Europe Index has gained about 13% in the past 3 months or so, achieving its strongest relative start to a year since 2000, in marked contrast to its performance, which has been lackluster over the past decade. It may be easy to dismiss the rise in European stocks as little more than just a value-based portfolio rebalancing. After all, at a forward PE ratio of roughly 14 times versus 22 times for the U.S., relative value for Europe has been at multi-decade extremes. However, there also appear to be some fundamental catalysts behind the resurgence. First, consider economic surprises in Europe, which have started to meaningfully outpace those in the U.S. In fact, over the past 3 months, we've seen European PMIs and earnings revision breadth improving. Also, while the U.S. Fed is now expected to cut interest rates only once this year, the European Central Bank is expected to cut 3 to 4 times. And then there's the specter of meaningful political change across major countries like the UK, France, and Germany that might lead to more aggressive fiscal policy. While these are notable dynamics, there's an even more compelling argument for sustainable growth, namely the prospect for peace in Ukraine. Consider that investors may be increasingly willing to discount at least 3 benefits of a ceasefire. First is the potential that Europe will benefit from massive reconstruction in Ukraine. According to the World Bank, restoration projects could generate as much as $486 billion in new engineering and construction work over the next decade. Although MS & Co. research analysts view that number to be high, it would nonetheless add a huge tailwind to much anticipated infrastructure spending. Second is the stimulus that's likely to come with EU and NATO fortification of defense spending commitments, possibly taking the total from about 2% of GDP now to 3.5% over the next several years. This potential is increasingly being reflected in defense stocks. An index of European aerospace and defense names is up about 18% since Trump's election, outpacing both U.S. and EU stocks. And finally, while political dynamics remain complex, there are hopes around the resumption of natural gas deliveries from Russia, possibly easing inflationary pressures on energy prices. Now, this may all point to a better backdrop for Europe than in the recent past, but we're reticent to embrace the moment as the start of a new bull market. Recent events emanating from the Munich Security Conference and the White House regarding America's approach to peace talks with Russia could be read as marking a shift in global allegiances. With much more still to be determined and with U.S. policy positions seemingly getting defined in real time, we believe material uncertainty remains. This means now is not the time for investor complacency, and we suggest prudent diversification. Consider bolstering geographic diversification through strategies focused on global leaders with quality balance sheets and strong brands. Complement with regional overweights to Japan and emerging markets, where MS & Co. Research recently upgraded the MSCI China Index. Thanks for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.